So now that Luscious Landscaping has done all the necessary adjustments to be GAAP compliant, they have all of the revenues and expenses on the books that have to be on the books for the accounting period that we are accounting for. We are ready to make our financial statements. When you prepare your financial statements, you always have to prepare them in the same order because some statements have numbers that you'll need on later statements. I'm only starting this class off with the three main statements. The income statement, basically what we made during the period. The statement of owner's equity, how the value of the business changed during the period. And the balance sheet, which is a comprehensive look at our financial position, namely what we own, our assets, what we owe, our liabilities, and what we are worth, our equity accounts. But we got to start with the income statement because we're going to need the bottom line number, net income, here for our other financial statements. Well, how do I prepare our income statement? Well, we have the balance right here of all of the accounts that we are going to have on our books that are going to show up on our financial statements. And we made them in a very nice order to make things easy. What goes on the income statement? Revenues and expenses. Basically, what we made versus what we paid for is the amount of profit we had during the period. Sometimes they call these a P&L statement for profit and loss. All of those are down here at the bottom. We have how much revenue we made during the period and what each of our expenses were. So all I have to do now is just copy all of these numbers over here into our statement. There are two columns in this statement, the left column and the right column. The right column is for your totals, and the left column is where you put the individual lines that you add up. At this point in time, we only have one revenue account. And since obviously if we only have one account, our total revenues are going to be equal to the balance of that one account, I'm going to put it right onto the right-hand side. And I'm going to go and I'm going to grab that number from our adjusted trial balance. And right here, after adjustments, we said that we have $5,800 worth of revenues that we have to recognize. I'm going to bring that number on over. If I did have other revenues, if I had interest revenue or rent revenue, there was like 3-4 different things, I would have put the individual totals in the left column, or the individual amounts in the left column, and then the total revenues in the right column. But since we only have one, we're just going to shortcut it and put service revenue in the right column. But for expenses, we do have a bunch of individual items. We have our salaries expense, and our salaries expense was $27.60, so let's bring that number on over. We have our utilities expense. Our utilities expense was $225. Let's bring that number on over. We have rent expense. Rent expense was $600 according to our information. Let's bring that number on over. We have depreciation expense. Depreciation expense recognized during the period was $350. That's the balance of the account after we made our adjustments. Let's bring that number over. Supplies expense has a $200 balance, so we're going to report $200 for the supplies expense for the period. And then interest expense has a $40 balance. We're going to bring that on over. And now I need to find my total expenses, which is just the sum of those 1, 2, 3, 4, 5, 6 different expenses that we had during the period. And if I add that up, we see that Luscious Landscaping incurred $4,175 worth of expenses during January of 20XX. So what is our bottom line net income? Well, we made $5,800 worth of revenues, but we incurred $4,175 worth of cost to do so. So revenues minus expenses, which is the formula for income, tells us that we are going to have reported net income of $1,625. That is the amount we'd have to pay taxes on for the most part. It's also the amount of profitability that our company had, the amount of money that's left over that their owner, which is the guy's name is Blogan Reams, could reinvest in the business if he wanted to and change the value of the business, which is why we have to do this first, because that net income number is indeed necessary for the second statement you're going to make, which is the statement of owner's equity. For the statement of owner's equity, what we're saying to the people that are using this information is this is how the balance of, I should say, the value of our business changed during the period. This is what it was worth at the beginning of the period, January 1st, 20XX. This is what our business is worth at the end of the period. Well, let's assume right here this is a new company, so it had no value when we started, before we started doing anything. There's two different ways that the value of the business can increase. Either the owner can contribute stuff to the business, which increases its value, or the business can operate profitably. So the two additions that you have to your financial position, to your owner's equity, are owner contributions and net income. In this problem, I've given the owner contributions is $34,600. In real practice, you have to go back through and look at your journals for every journal entry you had recorded for an owner contribution during the period. But for net income, we just calculated it, which is why we headed to the income statement first, because I have to copy that bottom line net income of $1,625 over to my statement of owner's equity. In this spot right here, where there is nothing written in here, I call this the no-name subtotal. It is just the sum of the three numbers above it. And if I add those three numbers together, I get $36,225. What does that represent? That represents what Luscious Landscaping would have been worth had this owner let everything ride, had kept the $1,625 of the profits that we made in the business and used it to grow the business later on. But that's not what happened. And I know that because going back to my adjusted trial balance, Mr. Reams withdrew $650 during the period. He didn't let it all ride. Our reduction to the value of the business in this case is how much our owner withdrew from the business. And I'm going to have that as a negative because it's decreasing the business's value, its equity. Go back over here and grab that number. It was $650. So the business had Mr. Reams reinvested every single penny of profit into the business would have had a value of $36,225. But since Mr. Reams withdrew $650 of that from the business, Luscious Landscaping ended the month of January 20XX with a value of $35,575. And since Mr. Reams is a sole proprietor, the entire value of the business is attributable to him, $35,575. Why do we need this number? Why do we make this statement second? Well, it's because the balance sheet has a spot down here for owner's equity. And I won't bury the lead. We have a number on our balance sheet for owner's equity. It was $34,600. But that number is not taking into consideration at the end the amount of income that the business had during the period, nor the amount that Mr. Reams or our owner withdrew. So for the balance sheet, the number that you report for your owner's capital, I'm going to put this in this spot over here in the rightmost column, is always equal to what your ending capital was for the period, in this case, $35,575. But for the rest of it, we got to report everything else, what we own and what we owe. All of those numbers will indeed be the same as what we have on our adjusted trial balance. There are three columns here, 1, 2, 3. The rule of thumb for these columns is if an account stands by itself, if the balance of that account has nothing else tied to it, it goes in the center column. So all of these guys up here, cash, accounts receivable, supplies, and prepaid insurance, they don't have any accounts tied to them. We can just bring over the balance of all these accounts into our balance sheet. Cash had a $16,650 balance. Let's bring that on over. Accounts receivable had a balance of $3,800. Let's show that to people that that's an asset that we have to work with. Supplies has a balance after we made our adjustments of $800. Bring that number on over. And for prepaid insurance, we have, oh, I got a typo. Let me fix that, $1,200. This shouldn't be prepaid insurance. It should be prepaid rent. There we go. See, I make mistakes too. So all in all, what do we have? Well, this is our current asset section. Of these current assets that we have a total of $22,450. Now the question is, what makes an asset current? And the thing that's the big divider for what's current and what's not current is 1 year. If you expect to convert something into cash, or if it is already cash, but if you expect to convert something into cash within the next year, you should report it as a current asset. We're going to collect those receivables within the next year. We're going to use those supplies to generate revenue within the next year. That prepaid rent is going to expire within the next year. So since all of these things are going to be assets that get used up, consumed, and converted to cash within the next year, they're going to be current assets. Down here, we have our non-current assets, or if you will, our PP&E, property, plant, and equipment. These are things that we're going to use to help us generate revenue for a period of more than 1 year. Going way back to the entries over here, the very first entry we did, we said we were going to use the equipment for 3 years and the truck for 8 years. Well, that's not within a year, so those are long term. The left column, if you have an account that's tied to another account, you put the balance of each one of those accounts into the leftmost column. So let's start with equipment. The balance of equipment, according to our adjusted trial balance on our worksheet right now, is currently $3,600. But it has an account tied to it, accumulated depreciation of equipment, how much value that equipment has lost since we started using it. This is going to be a negative number because it's reducing the value of this equipment. We bought it for $3,600. If we use it for a month, it's going to be worth less than what we paid for originally. So since I want this to be negative, I'm going to bring the number over as a negative by saying equals negative, and then go over to my adjusted trial balance and grab the balance of accumulated depreciation of equipment, which is 100. So now what our books are saying to the people that are using our information is we have equipment which we paid $3,600 for, but it has lost $100 in value. So what is it worth today? That number goes right here to the right-hand side of your contra account, of your accumulated depreciation account. If we had equipment that cost $3,600, which lost $100 in value, it's now worth $3,500. They call that the book value. So the book value of our equipment right now is $3,500. Let's apply that same concept to our other piece of PP&E, our other non-current asset, if you will, and that is our truck. What is the balance that we have of truck? Well, we go on over, we find the truck, and the truck has a balance of $26,000. But it has an accumulated depreciation account tied to it, which is going to reduce its value. So I'm going to bring over the balance of accumulated depreciation truck as a negative equals negative. Go back to my adjusted trial balance and see that the balance of that account is $250. So just like before, what our books are saying right now is that we have a truck which we paid for originally $26,000. Since we purchased it, it has lost $250 in value as we've been driving around and all of that stuff. So now the offset of those two numbers, $25,750, is what our books are saying our truck is currently worth today. Well, we could reasonably resell it for if we sold it to somebody else. So what is our total PP&E, our total non-current assets in this case? Well, we have equipment with a book value of $3,500, and we have a truck with a book value of $25,750. We have $29,250 worth of assets that we plan to use for more than 1 year into the future before they are expended. But all in all, our total assets, we have $22,450 of current assets and $29,250 in PP&E. Luscious Landscaping has $51,700 worth of stuff that they can utilize to help them provide the service that they do, landscaping people's facilities, to be profitable in the future. That is what we own. What do we owe? Well, for this, it's the same setup. At this point in your studies, you haven't seen any accounts that get tied to liabilities, which means all of these are going to stand alone. They're all going to go into our center column. Let's just bring over our balances. We need our accounts payable. Going over here, accounts payable was $500. So let's bring that $500 over. Salaries payable. What is the balance of our salaries payable account? Be very careful you don't grab salaries expense. It's not the same thing. Salaries payable had a balance of $360. Interest payable, that account has a balance of $40. Utilities payable has a balance after we made our adjustments of $225. And unearned revenue had an adjusted balance of $3,000. Just as above, these are current liabilities. What makes them current? We're going to pay them off in full, in total, within the next year. Accounts payable is money owed to a vendor. We're going to pay that vendor within a year. We better pay our employees within the next year. They're going to be very angry with us. We're going to have to pay off the interest on that loan within the next year. We're going to have to pay the utility company within the next year. We're going to have to provide those services that we got paid for in advance within the next year. So these are all considered to be current liabilities. They go in the current liability section of this classified balance sheet. And in total, if I sum those up, putting it in the rightmost column, where all the totals go, That's $4,125 of current liabilities that we have. But we do have one liability that's going to take more than a year to pay off in full. Going back to our entries down here, it's down here on this guy. We have a long-term outstanding notes payable. It's safe to assume in this class when I give you a notes payable, it's always going to be long-term because it's going to be a loan that we're going to have to pay on for more than a year in the future. In that case, we're going to report it under long-term liabilities, and the balance of that account is $12,000. So now what are my total liabilities? Well, I have $4,125 worth of debts that I'm going to pay within the next year. Luscious Landscaping has $12,000 that they're going to take more than a year to pay off in the future, but all in all, our company owes people $16,125. So down here, the last number that we have left is our total liabilities and our owner's equity. Our liabilities are $16,125. Our owner's equity is $35,575. And when I add those numbers together, I come up with, ta-da, $51,700. I'll even make it yellow. The same number on both sides. This is the balance sheet. When they say your books are in balance, that means that a thing called the accounting equation is true. And what is that equation? That your assets always equal your liabilities plus equity. So since that number works out, we know that our books are looking pretty good to show to people. You have to have these two numbers match at the end. They do for Luscious Landscaping, so we're feeling pretty good about handing off our financials to other people to look at. And what would they say if they looked at our financials? So let's go through and just look at things. We made more revenue than we did expenses during the period. We turned a profit. Now, granted, it's not a huge number, but we're a very small business starting up. At least we were profitable during our first month of operations. That should be, sustainable. That should be able to continue. And with that, if we keep making profit, it should allow the business to grow. Speaking of the business growing, did the value of the business grow during the period? It absolutely did. We started with zero value. Owner contributed some stuff. We had profitable operations. The owner withdrew less than the money, less than the company made during the period. The value of our business increased during the period. So people can look at it and say, not only is the company profitable, but the owner is reinvesting into the long-term success of this business. And lastly, what do we own? What do we owe? And what are we worth? Well, we own $51,700 worth of stuff to do business with. We only owe $4,000, a little over $4,000 worth of payments to somebody else. And in fact, one of those is unearned revenue. That's not even something you need to pay cash for. You just got to provide the service. We have very little debt that we're obligated to pay within the next year. We do have a long-term note, so we're in a little bit of debt right now. But the amount of debt that we have in total is less than our cash. If we wanted to, our company right now could turn around and pay off all of this debt with its cash that they have in there. We're in no danger of being, as they say, insolvent, of going bankrupt because we can't pay stuff. And all in all, the value of the business greatly exceeds the amount of liabilities that we have. We're looking like we're in pretty good shape. Luscious Landscaping is off to a good start. Last point before I end this video is you'll notice as I was going through here, yes, we had left columns and right columns, here and here and here. I never said debit column or credit column. Debits and credits only exist in your journal entries, your T accounts, and on the sides of your trial balance. On your financial statements themselves, they're not debits and they're not credits. There's different formatting. Like on this one, all of the individual line items, as they call them, go on the left side, while the totals go on the right side. For our statement of owner's equity, we only had one column because we didn't need to total anything up. And for balance sheet, it wasn't, this is a debit and this is a credit and what goes here and there. It was accounts that stand by themselves, stick in the middle. Accounts with other accounts tied to them go on the left-hand side, and just totals or individual lines go in the right-hand side. So don't think that you have to have all of your debits and credits move over. You should only have one number present for every single item, account that you're reporting on your financial statements.